amortizing, and their reporting. Okay, we have 5 problems to do, and I am your local learning commons specialist in business, Jabari Powell. So sit tight and we'll get started. All right, so question 1. On January 1st, Applied Technologies Corporation, ATC, issued $500,000 in bonds that mature in 10 years. The bonds have a stated interest rate of 10%. When the bonds were issued, the market interest rate was 10%. The bonds pay interest once per year on December 31st. Determine the price at which bonds were issued and the amount that ATC received at issuance. Okay, so if we check out what it says, it tells us that the bonds were issued $500,000 and the bond stated rate is 10%, while the market interest rate is also 10%. When the stated rate is equal to the market interest rate, then the bond will be issued at face value. So that means they will be issued at exactly $500,000. Okay. And I'm going to check my work real quick so you all can see. Answer is complete and correct. Okay. Question 2 asks us to complete the required journal entries to record the bond issuance and the first interest payment on December 31st, assuming no interest has been accrued earlier in the year. Okay. So the bonds issued, it was issued on January 1st. So this will be a full year. So for the bond issuance, so to record the issuance of bonds of $500,000, okay, the company received cash of $500,000. Okay, so we're going to debit cash of $500,000. Okay, and they issued bonds payable. Okay, and they issued bonds payable of $500,000. Okay, if I go down, I check my work. The answer says it's not complete. It says it is not complete because we have not done the second journal entry. But if you check, cash, bonds payable, debit and credit are correct. Okay, so let's look at the second journal entry. The second journal entry says record the interest payment on December 31st. Okay, so if we go back and we look, we said we issued $500,000 bonds with an interest rate of 10%. So if we go, we will say, okay, we had to pay interest. So that is interest expense. We paid cash. Okay. In order to come out with the amount, we multiply the principal, 500,000 times the stated rate, 10%. 500,000 times 10% is $50,000. Not there, but the next 500. Okay. And we credit cash this time because we are spending cash. So if we scroll down, check my work. Answer is complete and correct. Answer is complete and correct. And they are both complete. Okay. We're going to go on to problem 2. I'm going to be back in just 1 second. I'm going to go actually grab my answer sheet that I have. I'll be right back. If any questions come up or if anybody comes up on live feed, Bob, let me know. I'll be right back. So we're going on to question 2. Question 2, Grocery Corporation received $300,328 for 11% bonds issued on January 1st at a market rate of 8%. The bonds had a total face value of $250,000, stated that interest would be paid each December 31st, and stated that they mature in 10 years. Assume Grocery Corporation uses the effective interest method to amortize the bond premium. They want us to complete the required journal entries to record the bond issuance and the first interest payment on December 31st. Okay, so first we need to record the bond issuance with a face value of $250,000. Okay, we are going to actually receive $300,328. That is the cash. Okay, $300,328. Okay, we are issuing a bonds payable, so that will be a credit for bonds payable for the face value, $250,000. Okay, because the amount we receive is greater than the value of the bonds payable, we call this a premium on bonds payable. This premium is equivalent to the difference. 300,000 minus 300,328 minus 250,000 is 50,328. Okay, that's the first journal entry. The second journal entry that we must record is record the interest payment on December 31st. The interest payment will be the amount of cash paid will be 11% times 250,000. Okay, that is the amount of cash that will be paid. The stated rate 11% times the face value of 250,000. Okay, so that is the cash. Now I'm putting this last because we have to put our debits before credits, but I know that my cash will be paid as $27,500. Okay. From there, you calculate the amount of interest expense by multiplying the book value, 300,328 times 8%. 300,328 times 8% will be the interest expense. Okay, that will be 24,026. The difference is the amount that will be amortized to the premium. Okay, the difference will be amortized to the premium, and the difference here is 3,474. Okay, go and check our work. All right. So just to review one more time, we received $300,328 for a bond that was issued at $250,000. That means we received a premium of $50,328. When we paid interest of $27,500. The interest expense was recorded as $24,026, which is our cash, our book value, $300,328 times the stated interest rate of 11%. Okay, and the premium on the bonds payable, the amount that's amortized, is the difference between the two. All right. Still has no one showing up yet, so I will continue on. All right, question number 3. On January 1st, when the market interest rate was 9%, Seaton Corporation completed a $200,000 8% bond issued for $187,163. The bonds pay interest each December 31st and mature in 10 years. Assume Seaton Corporation uses the effective interest method to amortize the bond discount. Complete the required journal entries to record the bond issuance and the first interest payment on December 31st. Okay? So we are going to record the bond issuance first for $187,000, $187,163. So that is the cash received. Okay. This is for a bonds payable. It has a face value, $200,000. So that is what goes here, $200,000. All right. And now the discount is the difference. So the discount on the bond payable is the difference between the cash received and the face value of the bond. In this case, the discount is, I just wrote this in opposite order because our debits have to come before our credits. I'm going to change these. This is going to be my discounts on bonds payable, and then this will be my bonds payable. Okay, sorry for that. This should be 200,000, and this would be the difference between 200,000 and 187,163, which is 12,837. Okay. And now to record the interest payment on December 31st. The interest payment, the cash amount is equivalent to the face value of 200,000 times 8%. 200,000 times 8% means a cash payment of $16,000. Okay. The interest expense is calculated always by multiplying the book value, in this case the 187 and 163, times the market interest rate, which is 9%. So 187, 163 times 9% gives us 16,845. The amount that will be amortized to the discount on the bonds is the difference between 16,845 and 16,000. That is 845. Okay, so if we check our work, okay, as you can see, it's all complete and correct. Move on to question 4. Okay. Question 4 and 5 are about how to record your bonds on your financial statements, on your balance sheets. So E-Tech Initiative Limited plans to issue 500,000 10-year 4% bonds. Interest is payable annually on December 31st. All of the bonds will be issued on January 1st, 2016. Show how the bond would be reported on the January 2nd, 2016 balance sheet if they are issued at 97. Being issued at 97 means they were issued at a discount. So the bonds, let's make sure we have, should be the long-term liability section. Okay. We're going to be using our bonds payable. And then because it was issued at 97, 97 is less than 100, so this tells us that this was a discount on the bonds payable. Okay? So the bond payable had a value of 500. The discount on the bonds payable, okay, 97, that's 3%, a discount. So we say 3% times 500,000, which is 15,000. Okay? And that gives us the carrying value of the bond. Okay? There should be nothing else. This should be all. That's not working. Okay? Answer is complete and correct. And question 5, very much similar, except this time the balance, this time they are issued at 102. So it's the same 500,000, 10-year, 4% bonds, but instead of being issued at 97, they are issued at 102. So in this partial balance sheet, we are doing the long-term liabilities. Okay, so that's the section we're in. We're recording the bonds payable at its face value, 500,000. Okay, and then we also now, because it's issued at more than 100, this is a premium. Okay, if we do this premium is 2%. So if we do 2% times 500,000, we get 10,000. And it's not going to be effective, but this is 10,000. This is a premium. This should be added to the amount of the face value, which gives us a total of 510,000. And as you see, our answer is complete and correct. We are finished. I will go back and review each of the problems one more time. And after that, we are concluded. So question 4 was, how do you report the issuance of a bond on your balance sheet if the bond is issued at a discount? We record the face value on the bonds payable, and we multiply the discount percent times the face value. Okay, so there was a 3% discount, so we multiply 3% times 500,000 and get to 15,000. Okay. Question 3 is about how to record the issuance and how to calculate the amortization of a discount on a bond. So if it was issued at 200,000 face value, but for 187,000, then we know we received a discount on the bonds payable. The discount is equal to the difference between the face value and the cash received. Okay, and then to calculate the cash, you multiply your face value times the stated interest rate, whereas your interest expense will be your book value, the cash at issuance, times the market rate. All right. If there are any questions, please stop by. Feel free to stop by the Learning Commons anytime. Today I'm available until 1 o'clock. Next week I'll be available all week, so please stop by. And thank you very much and have a good day.